Okay. And on page 8, there is an illustration. I would like to share with you how to get the numbers on these examples. Okay. So time to read the question first, and then I will go back. Okay, coming back. Here is an quite good example to share with you how to work on the NPV and IRR based on this simple information. A company, okay, is involving in making a decision between a pair of mutually exclusive projects. Okay, remember, mutually exclusive projects, it means you can only take one. Only one accepted. Only accept one project, only one accepted. Okay, only one accepted. X and Y, okay, you can choose either one. The cash flows of the two projects are as follows. First year, okay, year 0, both cash outflow, and then from first year to third year, they have cash inflow. Given the risk involved, it's judged that 6% would be an appropriate NPV discount rate and IRR hurdle rate. So required. Which project should they go for using NPV and IRR? Okay, based on 6% discount factor, we have 3 years. Okay, so highlight here the discount factor that we were adopted. So share with you the calculation on this. If based on NPV method, okay, we would like to do a simple calculation. Okay, for X first year is minus 1,000, and then 400, 600, and 187. Okay, and for discount factor is 6%. For year 0 is 1. For the first year is 0.943, and second year is 0.890. Okay. So for X, the PV, X and Y. For X, 1,000, and for the first year, 300. Okay, 77.2, 534, and 157. So altogether, okay, what's the net present value of all these numbers summed together is 68. And how about Y? Okay, initial investment is 450, and then is 283. Oh, sorry, 450, and first year is 300, 150, and 106. So the PV calculation, 450 initial investment with discount factor at 1, and then in the first year we got 283, second year 134, and third year is 89. So altogether is 56. So which one is better? Obviously is project X, right? Because 60X is greater than 56. Okay, so NPV finished. How about IRR? Okay, for IRR calculation, I would like to introduce the method called interpolation. Okay, it's also recommended by ACCA. Remember, a normal the cash flow here, the pattern. Okay, the cash flow pattern is conventional or unconventional. Okay, here, first year is minus, and from initial investment is minus, and then from the first year to third year is positive, right? For both X and Y. So here is conventional cash flow pattern in which the IRR we assume in the graph. I hope you remember the graph. Should be like that, the IRR line, right? So we use the interpolation method to estimate, or how to say, to make the trial and error of IRR. And since 6% discount rate will give both X and Y positive NPV, right? So referring to chart here, okay, here I assume is 6% because it's positive NPV. Okay. So how to make the NPV is negative? Okay, we would like to use the line here. We would like to have the positive NPV here. We would like to use the negative NPV here. Maybe here. Okay, you can see my drawing here. Then we got one positive, one negative. We can estimate. The IRR. So I assume 20%. Here, 20%. Okay, 20% is a wild guess. Should be make both projects a negative NPV. We have positive NPV, we have negative NPV, then we can have the form, I can share with you how to get the IRR based on one positive NPV and one negative NPV. So I assume 20%. Okay. So do the same thing is to discount the cash flow and find out their numbers. Okay, all these numbers are from the question, so I just write it down. So discount factor for 20%, okay, for the year 0 is 1. It's no doubt is 1. And for the first year is, okay, 1x33. And for the second year, 0.694. For the third year is 0.579. Okay, so I get for the X 1,000 minus is the cash outflow, and for the first year is 333, and then it's 416. The last year is 108. So if you sum them down, altogether is minus 143. For Y, $450, and then for the first year is $250. For the second year is $104, and then it's $61. Okay, altogether is minus $35. Okay, so we got X is minus 143. Y is minus 35. So we get positive figures and negative figures. So remember, when 6%, for X is 68, for Y is 56. So we mark it down. We all have this number, this number, this number, this number. So, okay, I give you the formula. Then you can get the IRR numbers for X. Okay, 6%, which is making the NPV positive. So when the NPV is positive, is 68 divided by 68 minus. Okay, if you remember the chart, right? Remember the chart? I said here is positive and here is negative. So here the NPV is 68 and here is minus 145. Okay. So based on some mathematical equation, I can guess here is 6%. Okay. And here is 20%. So I know the IRR should be higher than 6% and lower than 20%. Then I get 6% plus a ratio times 20% minus 6%. So I get X, the IRR of X is 6% plus 4.5%. Okay, because I do the calculation before the class started, so you can check my calculation is correct or not. Okay, if I'm wrong, just let me know so I can correct it. But I check it again and again, so make sure it should be correct. Yep, 4.5%. So all the total is 10.5% IRR for X. And for Y, based on the same logic, $56 divided by 56 minus 35 times. Okay. You can see 6% plus 8.6%. it comes to 14.6%. So based on the IRR, which projects that I should accept? Okay, should be project Y. Okay, they are mutually exclusive. So I take project Y instead of project X. But if based on NPV, I should take project X instead of project Y. And the company discount rate, required discount rate is 6%. Okay. So for the IR decision rule, I choose Y. But for Y, the value, the net present value, is only 56, right? Less than project X. So be careful of choosing the projects by applying IRR. So here we comes to the weakness of IRR. What's the problem of IRR, or what's the assumptions of IRR? First of all, IRR means the rate of return making the NPV is 0 for a project, and all the future cash flow, the investment rate of the future cash flow, the return is same. Okay, what does it mean? For example, you have cash flow 1, cash flow 2, cash flow 3. Okay. If the IRR is 15%, it means from the cash flow 1 to cash flow 3, okay, all cash flow generated, they have the reinvestment rate is 15%. So what's the problem? What's the problem? The cash flow generated from a project will have the same reinvestment rate at 15%. Is it realistic? Okay, is it realistic? For example, if you have the cash flow generated in the last year, or in the second year, you have the 15% reinvestment rate in elsewhere, not in the same project, in elsewhere. Is it possible? It seems not. Okay, but with our NPV, it is the cost of capital. Okay, it's the company cost of capital. So the reinvestment rate is based on the cost of capital, which is the company required rate of return. It is much more sensible in terms of definition, because you cannot assume the project cash flow will invest at the higher rate than the company cost of capital. Okay, it seems not realistic, or quite, how to say that, not meaningful, okay, especially in finance professional. So it's the key assumptions of the IRR in which the reinvestment rate of return is criticized by a lot of people by adopting this principle to evaluate the investment of project. And IRR, we share with you for project X and project Y. Okay, is it good to use IRR in choosing the mutually exclusive projects? It seems no, because we choose Y, project Y, the NPV of Y is lower than project X. Okay, it's lower than project X. So, but we choose it based on the IRR rule. So it seems not a suitable method. Okay, when multiple IRR exist, then the decisions will be inconsistent, as shared with you. Okay, discount factor percentage is the NPV. Okay, if you have an unconventional cash flow pattern, you have two IRR. Okay, the decisions are inconsistent based on which IRR you adopted. For example, here is only, for example, 3%, and here maybe 16%. Okay, maybe your cost of capital is 10%. Okay, so here reject, here accept. Okay, inconsistent. Then why NPV is preferred? Why NPV is preferred? It allows the comparison may be made between projects with different size and length of time. We just share with you project X and project Y is a good examples to share because two different projects have two initial investments. Okay, one project X initial investment is 1,000. The project Y smaller scale is only 450. Okay, but if you would like to compare different projects, okay, like different size and length of time, then NPV is much preferred because it will not discriminate. It will not discriminate a big project or small project. You're only concerned about the NPV of the project. Okay, but for IRR, okay, it depends. Okay, reinvestment rate may be higher for some projects, then it will be chosen, but the NPV is lower. It's smaller. The cash flows are discounted at the required rate of return of our investors. Okay, here we are talking about the cost of capital. Okay, the cash flow are discounted at the required rate means using the same cost of capital as we share with you. It's much better than using the IRR because IRR is a break-even point of the project, and adopting the same reinvestment rate by all cash flow generated in the future. So it is not so sensible in the assumptions.